Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, October 29th, 2019. Skipped yesterday's market wrap. Members, as I told you, I probably wouldn't be home in time for that. I had a 3:30 doctor appointment, which I told you I'd probably pay dearly for, having that set late in the day, having to have rescheduled it from being sick. And I kid you not, I sat in that doctor's office for over 2 hours and sat with the doctor for a full 10 minutes. That's how bad the wait time is here in South Florida. They call it land of the newlywed and nearly dead. So we've got a lot of busy doctors' offices down here. Anyways, I digress. Let's go to the charts. I'm going to cover some of the things I covered in this morning's update in previous video for members. And then I'll kind of recap some levels, and I have some new things to show you here. So let's start out. We'll get into the charts in just 1 second, but what I had stated earlier today is my expectations that the market's probably not going to do much today and or tomorrow, at least till later tomorrow afternoon. And the reason is threefold, really. Number one, we have the FOMC announcement tomorrow. Let's dive into that. Let me get into that real quick and show you what I'm looking at here. So here's on rightsideofthechart.com, and we're going to look at one thing additional in this video. Whether you're a member or not, if you click on the resources tab here, you have this tools of the trade. Now there's a lot of tools out there. I have bookmarks galore, but these are some of my favorites. I visit these frequently, and I recommend that especially now during earnings season. Keep in mind, we will be, at least in my opinion, over the hump on earnings season after tomorrow. So that's what I was saying earlier. You have the earnings calendar right here. Click on that. It'll take you to earnings.com. The big ones, we have, of course, AMD after the bell today, although that's not a big market mover, but it could help set the tone in the semis. And then most importantly, we have almighty Apple tomorrow and Facebook. So you have the last two of the 5 market-leading FANG stocks that I follow, FAAMG, that make up the bulk of the returns, that, make no mistake about it, have done most of the heavy lifting in this market. So that's why, coupled with this other one here, if you click on the economic calendar link, it's going to open up the economic calendar. So again, what I had mentioned this morning, the reason why today my focus was on trading a lot of other things. We killed it with natural gas. Yesterday we closed out our Bitcoin trade for almost 30%. Natural gas for gas for about a 30% run and reverse that. So there's a lot of money to be made in the market, but it's not in the stock market right now, or at least not in the market major indices. So here's what, if you're trading right now, what you have to realize is the market is in a holding pattern. Tomorrow we have GDP in the morning at 8:30. GDP is one of the most important economic reports. In fact, this is the sole indicator, the only thing that they use to measure or to benchmark whether we're in an economic expansion or a contraction. A recession is simply defined as 2 contracting quarters of GDP. Now, they only report this quarterly, but keep in mind it's somewhat lagged. By the time they report it, it's a month after the quarter's over, nearly a month after the quarter's over, and it's highly subjective to after-the-fact revisions. I can tell you, in every recession that I've ever seen, they only tell you well in hindsight after they've revised GDP down that okay, we're in a recession. So thanks. Stock market's going to tell you first. Right now, things are still boom, we're still in an uptrend. So just something to watch tomorrow. And then here's the big one. You have the FOMC meeting announcement tomorrow at 2 p.m. They've been meeting this week, starting today. So you have that, and then again visit that economic calendar, and you'll see tomorrow after the bell is both Apple and Facebook. So therefore, as I said this morning, don't expect a whole lot in the market until then, because what it does, it goes in a holding pattern. Who in their right mind is going to take a heavy position, open new positions in front of things right before the FOMC and a big market moving stocks like Apple and Facebook? So if any fireworks are going to happen this week, most likely they're going to start here after the FOMC announcement and into Thursday once Apple and Facebook have reported. And so you can see there's still quite a bit on the economic calendar. Look for these red dots. They're showing you the big market moving reports. Enough on that, but there's also another thing I wanted to show you here in the tools of the trade. I don't talk about it often because I find it most useful at extremes, and that is a sentiment survey. You click on that, it's going to bring you to the AAII American Association of Individual Investor Sentiment Survey. And so what you want to look for on that is 99 98% of the time, or 95 plus, this is useless because you're somewhere in the middle. You know, everyone's going to have their opinion. Some people bullish, some people bearish. So you want to look for extremes, and there's different ways I use it, but let's just look at some simple things here. Let's look at on the bullish column right here. This is the percent of traders, you know, participants that are surveyed that are bullish or bearish. And let's just take a look at that. And let me tell you what stands out to me. Let's look at when readings have ticked above 30%, 35, yeah, 30% or higher. So I'm going to circle those here, circle those here. We've got one here. That's when it started, right about here. We have a few right there, July 4th. And then there's one right off here. Now you can scroll down and click right here. I'm sorry, the Sentiment Survey historical results, and they'll give you, and I can tell you right now, the reading before that, the last time we had a reading before that was May 9th, the last time before May 30th that we had a reading of 30 or higher, May 9th. So what I'm going to do is I'm going to write these down. Hold on one sec. Okay, I jotted those down, and I misspoke earlier. So the extremes you want to look for here, 35%, not 30, 35% or higher. And again, I'm going to circle them one more time or highlight them here, and I'll read you out these dates just so you can check this. And of course, you can visit that link yourself, check it out. So there it is, all readings so far this year. And going back, and again we have one right before that, and like I said, you can verify it there. If I load it, if I click on that, it's going to load a spreadsheet, an Excel spreadsheet. That's why I'm doing it this way. And that was again May 17th, and we had a very high reading of 43. All right, so I've written these numbers down, and now let's take a look at the chart and see what they mean. And this is what I'm talking about here. It's almost in a way kind of sad that it's the tendency of the masses to become bullish at the exact time, extreme bullishness with the exact time they should be doing the opposite, becoming bearish and looking for correction. So we're just going to go through these very quick. All right, so we just hit one October 24th. Remember, this is a week that's weekly, so you're going to have to, they come out, they publish that only once a week. So pretty much that's right here, the most recent. There we are, October 24th. The next reading of 35% or higher was on September 19th. You know what I'm going to do is put lines there. I have to find another board for you here. Okay, and here are those levels I just read you. Again, these are going back. We're going back into May. Every reading of 35 or higher. And I said May 9th we had a 43.12% bullish reading. And the week before on May 9th we also had another 35, above 35, 39% bullish right there. And this is simple stuff. I mean, these are by far the biggest corrections that we've had all year, and there's nothing huge so far. And of course, what happens is it kind of resets things. You had a lot of extreme readings over here. This is a big correction right here, and so this is where we're at again. So that's kind of the pattern right now. You get everybody gets bullish at the highs, and as I said, each of these, by the way, 1, 2, 3, 4. Were all marginal new highs, slightly above the previous high. That has been the clear pattern in this market. Make a marginal new high, and from there correct. And by marginal I mean anywhere from less than 1% to no more than 3% or so. So we'll see. All right, now let's look at the technicals, and I got to go back to this board. That's it. Here's your divergent high correction, divergent high correction, divergent high correction. This is just a series of divergent highs here. Divergence is still in place very much right now. So again, the market will have its day. We don't have any sell signals right now. That's the one thing I can say, just because we've had pattern of marginal new highs. Sometimes those reversals came right away the day after. Sometimes they came a few weeks after. So we're waiting for sell signals now. I'm going to get to the intraday charts. But until then, we trade things, in my opinion. The best place to make money in the market is anywhere but the stock market right now. Meaning, things that don't have any relation, or they're not even stocks at all. Here's Bitcoin. This goes back. This is just a few weeks. We made nearly 30% on this. Bought it down here in this bullish falling wedge, and then sold it yesterday. As you can see, each one along the way broke out of the wedge there, exploded up, and most of our gains were hit in just a couple days there, or made in a couple days there. It was it yesterday, so we hit the final target, book profits for 23% gain, and from there we're right at that trend line where it's consolidating. Like I said, it was probably a momentum fueled overshoot. And I also said this is, to me, a bear market rally. Get in, get out. It may certainly have more upside, and I said that to traders that are still in there. So I forgot to add the word hit here. But so that's it. And then today we had the same thing on our natural gas. Recently went into that. And pointed out earlier this month, back in October, this is the 60-minute chart of NG, natural gas futures. You got this downtrend line, which I later followed up on to show you as a falling wedge. And again, we also had a proxy trade in this to be made with UGAS right here, headed up here, which I slightly revised today. I had that target about 1742, and that was hit, and that was revised that down to about the 17 level because that aligned with the final target in nat gas. Here we go, nat gas trade, that 2.711, and we're able to reverse that. So on UGAS, that was good for about a 30% run, and on NG, not 30%, but it's NG's a leverage little sucker, as you know. If you're in that, that's per contract, that's probably, I don't know, well over $10,000 in just I would imagine in just a few days there, or a few weeks, I should say. I'm sorry, that was earlier this month. Or I should clarify, maybe not one contract. Depends how many contracts you trade. I'll usually trade, at least several NGs. So I think it's about a 15% run. Either way, good for, probably 4,000 per contract or so on that. Now back to the markets, and I want to show you some levels to watch. Posted earlier this morning on NQ right here. Let me grab that chart for you. Here's levels to watch, because we're not going to stay in this go nowhere kind of market forever. Again, we have the Fed coming out Wednesday. We have Apple, Facebook reporting. So earlier this morning, I posted here potential long entry, which I still think will get that, a bounce trade here off the 80.50. I had a support zone from 80.50 down to about 80.40. This is NQ 60 minute. And there's that 80.40. You can see what it is. It's the gap right there, the Sunday night. Futures closed down over the weekend, so there's your gap into Sunday night. Then it runs again from 80.50 down to about 80.40, and you have an uptrend line right here to watch as well. And as I've been saying, we have divergences now in place on the index, the large caps, SPY, QQQ, NQES, from the 60-minute charts all the way out to the monthly. I have them on the daily charts, the weekly charts, 60-minute charts, of course, as I just said, and even the monthly charts. And so what we're watching as far as the next sell signals go, like I said, the risk reward, if you want to trade this market, you want to buy it, I mentioned I stepped in long today, and I'm still in that trade. I'm targeting a bounce back up to this minimum, this trend line. I was hopeful it'd be hit today before the close, and it's probably might end up taking until later today, tonight, maybe overnight or into the morning to be hit. And if not, I'll stop out above under 80.40. The nice thing about NQ, if you take it as a day trade, as long as you don't take it on a Friday, because they shut down for the weekend, it's going to trade around the clock, so you can keep that position open with a stop in place and go to sleep and not have to worry about a gap against your position. So that's my plan there. So it's walking the needles, walking the needle's edge, or walking a tight wire, whatever you want to call it, picking up nickels in front of a steamroller, because I do think this trend line goes. I am looking at this divergence. Well, we are overbought here. We burned through the RSI divergence, but with an extreme overbought reading. I've covered this before. 85, it seems to be the magic number on the RSI 14 for NQ. When you get to that level, I'm going to circle those tags right here. There's usually not a lot more upside before at least a correction, and this was divergence right there. I'd have to go back a little farther on this chart and show you those levels, but I've covered that before. There they are right there. So you get the idea. You hit that level right here, you tend to have very little upside before a correction. You get overbought, correction. Actually, that correction really didn't end to there. That RSI never hit that 85 level again to that till right here, and you had a correction, little one, hit it again here. You had this correction, and we just recently hit it again here, and we're starting to correct with an extreme overbought condition. And you can see we still have the negative divergences in place here on the PPO down below. So that's what it looks like on NQ, so I suspect maybe a little lift in the futures overnight because we're at support into tomorrow. Again, barring any big headlines that come out of the blue, market will go in that kind of wait and see holding pattern until the Fed, and then the Fed will come out and hopefully give us a sell signal. And if I'm not looking for much more upside, the market could continue to do so. We've only just slightly made those marginal new highs, but to me, again, and so I went going back to the trades we've done on Bitcoin and natural gas and everything else, it's about risk reward. This market could grind higher for 3 months, it's possible, before a big correction or longer. But that risk reward profile to me is just abysmal. It's just not attractive. The downside potential, should these levels break, those divergences play out, far outweighs the upside potential in the market at this point. So therefore, why I'm sitting here telling you all this, I'm long. That's just a quick tactical trade. Strategically, I'm waiting for the next sell signals, and we'll have to see how that shapes out on the daily charts. These are 60-minute charts. These trend lines, I got to warn you, there's the potential for whipsaw signals with the Fed and earnings for Apple and Facebook and some others coming up. But if that level breaks, or I should say when it breaks, I'm looking for a pullback at least at 79.80. At that point, we take a look then at the daily charts on QQQ and SPY. Then we'll look at the 60-minute charts there as well. So I'm kind of looking something like this maybe until tomorrow. Maybe another thrust up within this wedge. Like I said, I'm just targeting the minor downtrend line at this point in time. ES, S&P 500 futures, this wedge shows nice and clean. I know there's a lot of lines on this chart, but we'll just highlight the ones that are most important right now, and that is this uptrend line here, nice and clean. When I posted this morning, I expected a pullback to that trend line and said that would be and my words were, I quote, let me show you that. Here, it was right here earlier today. Like I said, if you're interested in picking up nickels in front of a steamroller, ES is likely to offer at least one last bounce to the bottom, off the bottom of the 60-minute wedge before we break down Thursday, Friday. That was NQ showing you headed down there. With ES too, ES was a little above it at the time. You can see right there. So this is still the scenario. It was my scenario earlier today. I think we get one last bounce. Again, I cannot emphasize enough, it's a picking up nickels in front of a steamroller thing, because if we break on down through there, that could trigger sell signal. I just wouldn't expect fireworks. In fact, I probably won't even take the short trade if it breaks down before, because it's a gamble. We'll see. I'm thinking through this. As I say that, it's a calculated risk, and I will tell you this. I will probably go into the FOMC announcement with at least a starter short position tomorrow. Hopefully I'll get a bounce out of this current long trade on NQ. And again, because it's a calculated risk, the charts are skewed tell me that the amount of upside potential, should the Fed come out and be a little more dovish than everyone expects and market rallies on that, or as well as a earning beat on Apple. I mean, how much more is Apple going to go up? Gave back some today. But what's the upside here on Apple at this point with the RSI pushing this 80-ish level? This is my extreme level. I always say this: every stock and security should be treated different. You put up an RSI on your charts, they're going to give you the standard 70 level is overbought, 30 is oversold. You can change those settings, but you can see I treat just like on NQ a minute ago where I had a line at 85. Here's my Apple daily chart, and what this tells me is that when Apple hits 70, if you're long and you get out, you're getting out too early when it's in a bull trend. And if you short at 70, you're going to get smoked because it continues to go up. However, when it crosses this line here, hits this line here, the 85 or 80 level, almost 81, the upside is minimal. You could have shorted there. Yes, it didn't. It did go down. You were profitable right away, but if you wanted to get the big trade, you went underwater by a slight amount. That's probably less than 1%. And then the biggest drop that you had in years, 20-something% drop in Apple. The next time it hit that level right here, tagged that line, had a correction. You could have traded, small one, hit it again, and you notice the theme is in close consecutive order. This is divergence, negative divergence. You hit it once, divergence. Came in slightly higher or slightly lower. You hit it here, you came in again, slightly lower, equal, divergent high. Biggest correction all year in Apple right there. And we haven't hit that line since then. So, this is trading. This is how I look at things. You put the odds in your favor. So do I want to be long Apple here at overbought conditions? And it could certainly thrust up much, but it's at worst, I think if you short here, you might have to ride out a few more percentage points higher. It's not a stock. I don't jump in front. I'm not a gambler, so I'm not going to take a position on Apple in front of earnings, but I might on NQ because that's going to dilute out. Should Apple, have an initial reaction that's positive to earnings and gap up 4, 5, 6, 7, 8%, it's going to bring the NQ up, but not by that much. And again, this chart tells me it's just a matter of time, and your sell signal on Apple is going to come when it breaks down below this price channel, and we'll probably come back down here to at least that 216.41. But here's the thing about the charts and everything else. Apple's been one of the strongest stocks in the fangs lately. If this breaks, it's going to start changing things. If Apple comes down, it's going to change things on the technicals for the indexes as well. And that's kind of the bigger picture. This is the way I look at things here. You have that trend line off the December 24th lows. QQQ has been testing that now for what is this? 1, 2, 3, 4. Now the 5th week since we broke below it. There's that divergence high on the weekly. So what I was getting at here, should Apple break down, although that's a relatively minor correction I just pointed out, that's the initial target. What it's going to do there is bring the Qs down with it. And it's going to give us finally, maybe, possibly, a rejection off this back test of this trend line. Same thing with XLK. There's XLK, broke down the trend line off the December 24th lows right here on the week of Friday, September 27th. 1, 2, 3, 4. Now 5 weeks back testing it. The recent high was a divergent high. Okay, and we're almost done here. I want to show you guys 2 more things and we'll wrap this up. And again, we'll follow up on the markets. Let's get Apple, Facebook out of the way, the Fed out of the way, GDP, some of those reports, and so we might get an interesting setup. And if we don't, we continue to trade what's tradable. Oil today, we went long oil at the lows, posted that setup earlier, and that was good for better than 2% bounce today alone. So 2% in a day, you have to do that. You have to really work hard to get 2% in the market now, and it's going to take you it's take you about a week to get that. Something I replied, a member had mentioned, his thoughts here on the market putting in, a lot of the stocks putting in highs back in 2018, and I'm still of that mindset, and a lot of people are, that the economy has showed a lot of evidence that it has topped, not just the economy, but also the stock market. But the problem is, the stock market is no longer very diversified. It is all about tech. Technology is by far the largest sector in the S&P 500. So when the market broke out the new highs yesterday, it was because XLK broke out the new highs. Make no mistake about it. But here it is. So here's what I said there. Yes, the S&P 500 is comprised of 11 sectors. Those sectors are all right here, and you can use, these are the S&P or Spiders ETF, so that's the same company that's that these are the components in the S&P 500. So you have healthcare, topped back in October 2018. You have REITs. They're near an all-time high, but 2 things to that. Number 1, they don't move the needle on the S&P 500. There's only 2 sectors that have such an insignificant weighting that they hardly have any impact on the sector, and that is REITs and the utility stocks. Those are both also defensive issues. So you have REITs. So let me just show it this way. Here's what just made a new all-time high. As I showed you, technology, REITs, and utilities. So utilities are the only other one, a tiny, roughly 3% weighting, and they just made an all-time high. So you have what's making new all-time highs? Technology, REITs, utilities. And then we had just recently consumer staples back in September, but that's also a defensive sector. Now let's look at everything else that's not done that. Financials topped in January 2018. Let me just use a new box tool here. Financials, January 2018, almost 2 years ago. Industrials, January 2018. That's obviously an important sector of the economy. Energy, topped in 2014, over 5 years ago. Consumer discretionary has been holding up, and that's the whole theme of this market. The housing market and the consumer are holding up because the job market's holding up because the Fed has hyperinflated the stock market with easy money, and it's kept the economy afloat. Give it that, and the stock market. But I just want to point out that all these basic materials, another these are the tells. How's the economy doing? You look at basic materials, you look at industrials, you look at financials, and again, all of those have topped back in 2018. Communication sector, 2018. So again, this is a market, continues to rally like it's 1999. Back then it was .com, which of course tech stocks, and now it's tech stocks. They're just more established large cap tech. It's not the bubble it was back then. So now what we need to do is wait patiently and wait for the next sell signal or objective entry, and maybe it's a long entry. I just don't see it right now in the market. Again, there's too many other fish to fry that are offering much more attractive trading ops than the broad markets that have gone pretty much nowhere now for the last almost 2 years. Even though the S&P is at a new high, that new high we're only 5% above where we were back a couple years ago. And we'll wrap it up here. I was going through the earnings today, the recent earnings, and a company that stood out to me was AOS, A.O. Smith. I'm going to get to A.O. Smith in a second. I'll start here with FedEx. I like to look at things that the masses aren't looking at. Here's one that a lot of people know. This is no secret or surprise. For many years, FedEx has been considered a great proxy on the stock market or the economy, and also more importantly, a canary in the coal mine. A lot of things out there, coincident indicators don't do you much good. Things that move right in line with the market. What you look for are tells. For example, FedEx. That's one thing to watch. When FedEx slows down, it means, hey, global shipments are slowing down, online shopping, business shipments, things like that. And so there's been a fairly well-known pattern, I should say at least, of FedEx peaking back before the market. Back here, FedEx peaked in May of 1999. The S&P 500 topped 11 months later, and then you had the great 50+% bear market off that highs. That was the .com bubble right there. The next bear market started right here in October of 2007, and of course FedEx peaked. We had pretty much a double top high, so FedEx peaked, double topped about 1.7 to 1.4 years before the stock market. Again, FedEx in the green right there, the stock market white. There's the 55% drop during the last bear market. And here we are once again. FedEx peaked back in January 19, and it peaked. This isn't just a correction. This was a correction. This is a correction in line with the market. See this one in line with the market. What you look for, you don't look for drops in FedEx. If the market's going down, that's just a concurrent move. It's a component of the S&P 500. It's going to trade with the market. However, what you look for are divergences when the two start to diverge. And in this case, like I said, FedEx peaked back in January 18, where everything else I just showed you, all those indexes, and the S&P 500. Here we are, 1.8 years later, not really too far off these other numbers. And so again, so a lot of people have probably heard about that indicator, but here's one I found. But it's a company that I'm quite familiar with, and if you're in any type of construction, home building, renovation, or even you're a homeowner, you'll know of this company. Like I said in the video today, replaced my pool pump a few months back. That's A.O. Smith. And boat lifts, I did the same thing a couple of years ago. I had my the lifts on my boat lift, the motors replaced. A.O. Smith. They make water heaters, gas, electric furnaces for residential, commercial. And the thing about this company, I think it's a better tell than FedEx, is where I'm going with this. This is a U.S.-based company. Here they are. They're based in headquartered in Milwaukee, Wisconsin, and they have just direct exposure to the U.S. based on what they're doing. And you can see this chart is just and the timing is beautiful. Here they peaked back in July of 98. AOS again is the red and green. This chart here, the S&P is overlaid in white. The S&P 500 peaked 1.7 years later on March 2000. There's your bear market. AOS peaked in April 2006 right here. 1.5 years later, the stock market peaked. And again, so you're looking for these divergences all along. Look at this. This thing tracks the market perfectly. It moves up and down. It is showing you that their business is right in line with the U.S. economy, and the best measure that is the S&P 500. Although it's not a perfect index, it's the best one out there. You don't want to use the NASDAQ 100. That's almost all tech stocks. And you can see they correct with the market. They go up. However, what happened here? AOS peaked back in February of 2018. 1.7 years later. So you have 1.7 years before the market top, then 1.5, and 1.7 years ago AOS peaked. The stock market just made new highs. We'll see. So I have down here, you can see 20.XX to 20XX bear market. To me, it's just a matter of, does the next bear start in 2019 or 2020? We'll see. Anyways, I thought that's a compelling chart, and these are things that you want to watch, and we'll see. Who knows? All right, we'll wrap it up here. And again, kind of going over all this other stuff because we're not going to have a lot of tells, I don't think, on the market until probably Thursday. And then we'll see. And maybe it's a non-event, the Fed and Apple and Facebook. But as of now, the near-term trend is still bullish. There's some trend lines I showed you to watch on the 60-minute charts, and then we'll just have to see what develops on the daily charts. We'll look at candlestick patterns and trend lines and moving averages and all that good stuff. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.